All right, so welcome to another video. Today we're going to take a look at single app companies like Uber, Lyft, Twitter, Snap, and DoorDash. So I'm going to give you my thoughts and opinions. And again, keep in mind, it is my thought and opinion, just my personal take. It's not a recommendation. You can check out some more insights that I have on my website and grab a one-on-one coaching session. So like a single video session, or even you can trade with and work with me if you want to learn more about options and trading for 2 months, 3 months, 6 months, and much longer. I've got some great classes coming up, so definitely check those out. And there's some good materials and goodies on our Discord channel as well. Things like charts and that kind of stuff. All right, let's get started. I want to chat a little bit about stuff like this, like Twitter, and Uber and Lyft and so on. So I've used some of these companies in the past, like Uber and Lyft. I've used them a handful of different times. I used Twitter for a little while, but I noticed, you're posting out and then the post dies after a while. So the sustainability and the time value that it takes is just very expensive time-wise. Some of these apps, what it reminds me of back in the day, to be quite frank and honest, is Groupon. So if you look at Groupon back in the day, like this is a kind of a single cool thing. If you look at the valuation, it was trading around $500, right? So compared to, after all the splits and everything, this is one of the early ones when I think about it, it's a single focus, right? You got a good coupon, you prepay for the item, they take a cut. And it was fantastic. Back when it first started, I used it quite a bit for like gifts and stuff like that. It was kind of fun and interesting app to use, but overall, it's just been trending down from a financial investment, monetary standpoint. It doesn't see a lot of profitability, or it doesn't see a lot of investors coming in. And you can see like anytime it tries to hold, just over all these years, tries to hold. Finally, it broke down in 2020 and then again rejected, and it's back down into these lower levels. So you can see the stock is just going down. Even another company like a GoPro, which I traded quite heavily in this day in 2014, 2015, when that stock just started to like rocket and explode in this time frame. I traded quite a bit there. This stock also has not been able to kind of make its way. Now it's trying to hold that $5 mark and get back, but then again, just getting a little bit above is struggling because it's they do some additional things. It's not just single app focus, but it just reminds me of those things where they have kind of like a one product line, and it makes it very difficult for the customer to kind of adopt them. And remember, now you're playing in a big boy space, right? So if I could choose to invest in GoPro, what's coming down the pipeline in the next 6 months to a year, versus I could invest in something more stable like an Apple or Microsoft. Where do I want to put my money? So you start looking at, okay, I want to sprinkle my money. So could I put in a couple, percentage points of GoPro? Sure, you could. Or Groupon? Sure, you could. But would I put in 99% of my portfolio in it? Probably not. So I'd rather choose the good quality. It's kind of like going to the supermarket or store and you're kind of saying, hey, well, if I want to go and eat high quality food, there's probably only one or two aisles that's higher quality, more like the veggies, the fruits, that kind of stuff. It's more the high quality. But if you're looking at the junk food and stuff, this is more like the junk food in the supermarket that you're walking through and saying, hey, it's possible it could make you feel good and do some good things for you in the future, but it may not. Right? So it may not pan out and do well. So this is what I look at when I see kind of Uber and Lyft. Like you could see initially there might be some nice vibes and flow. Like here's our IPO at 40. And you got this stock that broke out and it did fairly well, for a little while right here. But then ever since then, the stock's just trending lower. It's just going down. Right. So it's not really flowing well. And you could say, oh, well, the story of this, the story of that, it's fine. But competing for my money on an investment standpoint, I have other choices. In the supermarket, you're choosing the best quality food that you want, right? If you've got 10 tomatoes, you're choosing like the better ones that you want. That makes sense. Or the bananas. Do you want the brown ones? Do you want the green ones? Or do you want the perfect ones for you? And that's what you're trying to do. So the same thing here is like, look, I could choose it, but do I have to? And that's what makes it interesting, that and why sometimes the stock price doesn't go up, even though it might be a viable, good company from a stock perspective. Other people are, choosing with their money, believing in the share value and possible earnings later on for it to go there. And the part of that comes down to also the user base, how much profit they're making and so on. But there's bigger companies out there. So anyway, when you start looking at something like this, it continues to go down and then it may continue to struggle. LYFT kind of trades in parallel with that. So you can see the same thing. We're now under the 20 and then you're getting back into 15. So these stocks, if you look at GRPN, this is a $13 stock. Now, granted, the number of shares is not the same, but look at this stock. They're right back in line with that company, with Groupon, LYFT, GoPro, that kind of stuff. They're back in there. Even though right now these are more popular, it's just that there's a lot more volume in here. We've got volume of 45 million, whereas Groupon here is trading only 4.4 million. So there's probably a lot less volume died out, right? But when you got Uber, it's just way more popular right now. You got 107 million on the weekly. But it's still just not there. Looking at Twitter, same thing. Again, it's got volume, and with Elon Musk wanting to buy it for fun, I guess, or whatever the case is, the thing is it really there from a huge profitability standpoint? It's not there. I don't see it right now. From choosing many other companies, 500 other companies that you could choose from in the market, why would you choose this one? Right? I'm not saying it's not a great company. I'm not saying that the use of that company is not good. They're great. They have their place in society. But from putting your money into it as an investment, do you want more of a higher risk investment or do you want more safety plays? So this is why it's kind of like, okay, it becomes a little bit more difficult to put your money into all of this because it's more of a higher risk investment. There's also things like DoorDash. You take a look at this one, same thing. Like this stock seemed to hold up fairly well, especially during a lot of the pandemic type of things where people were locked in and delivering the food and so on. But even this one's struggling. Like, look, here, and now it's going down. And I would suspect that it'll continue to go lower. Who knows, maybe the $20 level. Now, this one's valued a little bit more. It's at a higher price point, in other words, than some of the other ones, but it's still kind of like an app-based service, right? Very similar to Lyft and Uber and that kind of thing. So a lot of these stocks, they usually struggle. It's similar to kind of things like Spotify, the music industry. They struggle to kind of push through and become profitable. Spotify is coming back into this $100 level. So it's at higher points. Now it's boom, back down here. Just kind of like Pandora. I don't even know if it's still around. Here's Pandora. I don't know. I guess this is Pandora. Probably not. But Pandora back in the day doing the music, it's struggled. I don't even know if it's still on here. But anyway, my point is that there's these single app places. They're just struggle a lot of times. And that's why with Uber and so on, I wouldn't do them as a long investment. But I think from a trading opportunity, they can be very lucrative and interesting because you can trade them fairly well, either to the trend on the downside or other ways for when they get too far extended, they can pop fairly nicely as well. Just because there's a lot of liquidity in there and makes it a lot easier to get in and out of the positions as well. So that's what makes it nice, but I would be careful thinking that these stocks will go to the moon. So if you're kind of like a long investor in them, be a little bit more careful, cautious on it because they don't usually work out very well. Just seeing things over the years in the past, you can kind of do your own due diligence and compare. But they usually like have their, nice flash couple of years and then just falter. So be careful. That's just my personal thoughts and takes on these companies, kind of single app companies or very limited company exposure, meaning like they're not selling big machinery or equipment, or they don't have a lot of divisions. There's many other companies out there that have like a ton of real estate investments, like a McDonald's or distribution centers or much more behind them. And it seems much more favorable or much more safe to place your money in those, even though they may not have a higher base return in the future. They have some stability. So it just depends how risk averse or how aggressive you want to be with your money. So anyway, thanks for joining me. Enjoy the rest of the day ahead, and I will see you in the next video.